Diversification, the free lunch. John is feeling like a financial genius. His custom keyboard business is booming, and for the first time, he has a significant pile of excess cash. His first instinct is to double down. He thinks, I know keyboards, I love keyboards, so I should put every single cent back into the keyboard industry. He's eyeing a massive investment in a specialized switch manufacturing plant. To John, this feels like playing to his strengths. But before he signs the contract, a massive storm hits, literally. A freak flood disables the world's primary supply of specialized plastic used in high-end keycaps. Suddenly, keyboard production globally grinds to a halt. John's business revenue vanishes overnight, and his investment in the switch plant is suddenly worth pennies. As he sits in his quiet office, John realizes he's fallen into a classic trap. He put all his eggs in one very specific, very plastic-dependent basket. This painful lesson introduces John to the most important concept in risk management: diversification. As Brealey, Myers, and Marcus explain, diversification is the strategy of spreading your investments across many different assets so that the failure of one doesn't lead to the destruction of the whole. In the world of finance, diversification is often called the only free lunch because it allows an investor to reduce their total risk without necessarily having to give up their expected return. It sounds like magic, but it's actually just simple math and a bit of common sense. To understand how this works, John needs to distinguish between two types of danger. The first is what we call specific risk, also known as unique or diversifiable risk. This is the danger that comes from factors that only affect a single company or a small group of companies. For John, the plastic flood was a specific risk. A strike at a factory, a bad CEO, or a failed product launch are all examples of specific risks. The beauty of specific risk is that it can be eliminated. If John had invested half his money in keyboards and the other half in a completely unrelated industry, say, a chain of rainy day umbrella shops, the flood that ruined his keyboards would have actually helped his umbrella business. By holding a diverse portfolio, the bad luck of one investment is often canceled out by the good luck of another. However, John quickly learns that he can't eliminate danger entirely. The second type of danger is market risk, also known as systematic or undiversifiable risk. This represents the economy-wide perils that threaten everyone at once. No matter how many different stocks John owns, he cannot escape a sudden spike in national interest rates, a global recession, or a massive change in corporate tax laws. These factors move the entire market together. As John adds more and more stocks to his portfolio, he notices something interesting on his charts. The total risk drops sharply at first, but then it levels off. No matter if he owns 50, 100, or 1,000 different stocks, a certain amount of risk remains. This floor is the market risk. It is the price you pay for being an investor in the modern economy. John decides to test this theory. He starts building a stickman portfolio. He realizes that if he buys 20 different stocks in 20 different industries, he has already done most of the heavy lifting. Statistics show that once you reach about 20 to 30 well-chosen stocks, you have neutralized the vast majority of specific risk. But John makes a crucial observation. The quality of diversification depends on correlation. If John thinks he is diversifying by buying 10 different tech companies, he is fooling himself. When the tech sector crashes, they will all go down together because they are highly correlated. To get that free lunch, John needs to find assets that don't move in lockstep. He needs to combine his tech stocks with gold, or real estate, or perhaps agricultural commodities. By diversifying, John isn't just protecting himself from failure. He's giving himself the peace of mind premium. He no longer has to check the news for every single tiny event in the keyboard industry. He knows that even if one of his companies goes bankrupt, his overall portfolio will likely be fine, carried by the steady growth of his other 19 investments. This strategy changes John's entire philosophy of wealth. He stops looking for the one big win and starts looking for a collection of solid chances. In the business engine of his life, John now sees diversification as the ultimate safety valve. He understands that while he can't control the weather or the global economy, he can control how much he suffers when things go wrong. He realizes that being a smart investor isn't about being right 100% of the time. It's about making sure that the times he is wrong don't take him out of the game. John closes his ledger with a smile. He still loves keyboards, but he's just bought a small stake in a renewable energy firm and shipping company. He has finally realized that in the complex world of finance, variety isn't just the spice of life. It's the armor that protects his future. He is no longer a gambler. He is a portfolio manager, using the math of diversification to ensure that his journey toward wealth is a smooth, steady climb rather than a dangerous tightrope walk.